First of all, thank you all for joining. It's nice to have everyone here tonight. I'm Mike Kimple. I'm the founder of Financeable. This is our kind of intro to modeling session or course that we're putting together here. We'll be delivering tonight. I guess just really brief background on myself. So I've worked in banking, private equity, hedge funds, mutual funds actually as well, and also teach as an adjunct at Columbia and help run a nonprofit called Access Distributed that helps folks get into finance career. So kind of finance all around, finance teaching all around. Excited to be here tonight, folks, and excited to go through this session with you. On the line here, I have Leonardo Ting, who is helping me with the session. So Leo is going to be a TA here, and so is Kieran Jacob. They are all-star fellows in Access Distributed and are here to answer any questions you all have. So if you're working on something and you get stuck, definitely ping Leo, ping Kieran if you have any questions. So that's kind of my very brief intro here. In terms of this course, before we pull up the slides and everything, actually to that point, just drop this in. So one more time, I can't win. Everyone in meeting, there we go. And Kieran and Leo, just as a heads up, as people join, if they are just joining, they won't be able to see these links. You may have to redrop the links in the chat just for people's reference. So in the chat, I'm dropping the link to the presentation as well as to the Excel file that you'll need to work through this session. So if you wanna follow along on the PowerPoint, if you wanna follow on the screen, by the way, you can just follow along and listen. It's totally fine. If you want to go through the same presentation, you can download it with this link, or you can download the Excel file. In terms of this course itself, the overarching goal here is to really create kind of an on-ramp to financial modeling. So, I think when people first hear about potentially doing financial modeling, it can seem a little bit intimidating. There's a lot to it, a lot of things moving around. And we have put this course together in an attempt to kind of make the whole process a little bit easier, and hopefully a little bit less. Sorry. Hey, folks, just as a whole, folks, if you guys can say, sorry, we're having some, hang on one second, guys. Let's just knock this out. Folks, just as a broad comment, if you're coming in and you are not on mute, just make sure you're on mute because it's distracting for the rest of the group. Hang on one sec. All right, let me just go back here. So with that said, so trying to create an on-ramp for financial modeling, trying to make this easier for folks to learn about this subject matter. And I should mention that this course is really built in a way that even if you don't have either any accounting background or much accounting background, you should still be good to go here. We've tried to make it sort of digestible, even if you don't have that kind of full context. So I should also mention for anyone who's coming here for an advanced modeling session, this is not going to be an advanced modeling session. One last thing just to note before we pull up the presentation is with the work we're doing, if you have questions, please do ask. And particularly as I'm going through Excel, I'll try to explain everything that I do. If you see me doing something in Excel and you're thinking, hey, I don't know what you just did, can you just do that again? Just shoot me a direct message and I won't call on you. I'll just say someone's asking this and I will do my best to answer your questions. Someone's asking if we'll be able to view this video after. I think so is the answer. I'm going to probably repeat this session, by the way, hopefully either monthly or every month. So at the very least, there'll be a future session. I'm recording this. And my aim is to put it up on my YouTube channel afterwards so people can see it. Barring any major technical difficulties, which always seem to surprise me, sort of the difficulties we seem to come across, I will have this on the YouTube channel either later tonight or tomorrow morning. So hopefully that helps. So with that said, I'm going to hop over here and pull up the PowerPoint and we'll jump right in. So at that point, I'm going to just dive right in here and talk about what we are going to do here. So first thing, just as a whole, welcome everyone. I'm really excited again to have you all here. In terms of what we're going to cover, so we are going to cover financial modeling, but as you'll see, we're going to take a look at three statement connections, and we're going to start there because in order to build a model, you really need the three statement connection understanding in order to kind of see what's happening. Again, you don't need to have a full accounting background to do this, but we are going to try to cover a little bit of the three statement connections and how they work before we build our actual financial model here, which is going to be a very basic model that covers entering in historicals and then also building out some basic projected numbers. Beyond that, I should note that while most of modeling is not an interview prep topic as it relates to interviewing for investment banking, for private equity, for hedge funds, for those sorts of things, there are a few questions, and we'll actually cover them at the very end of this, that do creep up from time to time in interviews. And so in addition to showing you kind of the basics of building a model, we're also going to talk about how this could tie into interviews as well. Again, that's going to be kind of the last thing we talk about tonight. Beyond that, for anyone who's been to these sessions before, I love questions. I love hearing your questions. I want to hear any questions you all have. I always make a pact with any group that I teach. So to that point, if you have a question, just DM me the question. I will not call on you directly. I'll say someone is asking this question. And by the way, if I don't think it's going to totally apply to this course, but should I ask a question where I say, what is this or what is that? And you want to give it a shot, just DM me the answer and I'm only going to call on you if you're right. So I want this to be a fun environment, enjoyable environment for everyone. And with that, let's jump in here. So to kick things off, I want to talk about kind of the broader approach of what we're doing here in terms of this course and really what we're after. I learned to build financial modeling far longer ago than I care to admit. And I think, the way I learned it, the way a lot of people learn it is you kind of dive right into the deep end of the pool. And it can be really confusing, really intimidating if you take that approach, understandably. What we're trying to do here is really give you the foundational understanding of what this should look like from a big picture view. And in my experience teaching folks over time, if you have that big picture view nailed down, the rest of it falls into place. But if you miss that big picture view off the bat, it's just super confusing for a very long time. To put it in sort of an analogs term, if you think about building a house, the way I think about it is like when you build a house, you start with a foundation, you kind of add things to that foundation, you slowly build up, you build the frame of the house, and then you add things to the frame of that house. And that's how you should build a house, right? And you're learning, or anyone's really learning in this world, that we'd guess probably any world, should roughly follow something similar. If you start with, the furniture and the wallpaper, you're going to end up, and don't focus on the foundation, you're going to end up with a really shaky building, and it creates problems for you for years to come. And you have to kind of keep coming back and trying to fix things. So really trying to pin down that foundational understanding here to make your lives easier, hopefully over the next few years as you pursue careers in finance, learning about financial modeling, and so on and so forth. With that said, and as I go through this, folks, if you have questions, I'm guessing there aren't questions yet, but if you have any, please do send them over in the chat. I've got the chat up here and I'm keeping an eye. So to that point, we're going to jump right in here and talk about financial modeling. So I said you don't have to understand accounting. I'm going to give a little bit of accounting here, but also some visuals to hopefully make this easier to see. So in finance, in accounting, there are three financial statements, and these three financial statements are core to understanding how to analyze a business financially, and also just understanding how to build a financial model ultimately. As we think about these three statements, the thing to understand is kind of what they do and sort of what they're meant for. And I'm going to cover that really quickly here and on the next slide. So to begin with, the income statement shows us how much underlying profit a business has made in a given period. Now, the big catch with this, which is a little beyond the scope of what we're talking about here, we cover this in depth in our accounting course, is that they're capturing, the income statement captures underlying profit, not necessarily cash that goes in and out. And we'll get to some examples of that in a little bit. The balance sheet captures the cumulative balances of a company at a given point in time. So I should mention the income statement is how much money do we make in a period of time. The balance sheet is where do our accounts stand at a point in time. It's kind of like your bank account. So if I have a bank account that has a bunch of transactions, if I look at it on any given day, it's going to have some accumulated balance. The balance sheet is basically that, but just with a bunch of additional details. It's long and short of it. And then finally, we have a third statement called the cash flow statement that helps us isolate the cash in and out for a particular business. So the underlying profit here doesn't necessarily, Leo, Karen, can you just get that? Thank you. The accounting, as I said, doesn't necessarily reflect cash. And so we have this third statement called the cash flow statement that actually tells us how much cash came in and out of the business in a period of time. And that's kind of its role, that third statement. So what we're going to do is build a model where we actually lay out these three statements and actually have a dynamic presentation of all three. Now, very quickly, for those of you that are a little more visual, just to kind of show you what these three statements are doing just one more time, and then we'll jump ahead. So quickly kind of recapping almost what I just said, the income statement is going to reflect transactions. So it's going to reflect purchases and receipt of money and expenses and so on. And then we accumulate all of the transactions in the the transactions that are generated by the business in a period on our balance sheet. So transactions accumulate to this thing called the balance sheet, which is presented as assets equals liabilities plus owner's equity. If you're not familiar with those terms, not the end of the world. The punchline is assets are what we own, and the other side is how we paid for it. And there are basically three ways to pay for things. You can either borrow liabilities, you can invest money, which is owner's equity, or you can invest the profits of the business, which is also just a different form of investment. And that's also an owner's equity. So assets are what we own, liabilities are borrowings, and owner's equity is basically investment in the business or reinvestment of the profit of the business. And that's the accumulated balance of the business is accounts at a point in time. And then finally, going back to what I was saying on the previous slide, this accounting system basically captures cash, non-cash, and a bunch of sort of substance, but not necessarily the money that went in and out. So we have this third statement that takes all the transactions and everything that we capture and then cleans them up and ultimately turns that into underlying cash. So those are the three statements, and that's really what we're going to model. The big difference between accounting and financial modeling is that we make everything dynamic. So what we're going to do is we're going to take the numbers of the business and make it so that when we update something in one part of the model, it flows through the entire model. And that's really financial modeling in a nutshell. So with that said, I'm going to jump right into the actual model building exercise here, and we will kick things off. So as is the case with all of our courses, we're going to build this around like kind of a mini case, a fictitious case. And what we're going to do here is imagine that we have just started. Question for the group. I'm actually curious if can you all hear the pinging of the people coming in and out on the waiting room? Okay. So yes. Give me 1 second. Let me see if I can just stop that for 1 second. I apologize. I did. Bear with me 1 sec. Let me see if there's a way to. Let me just bear with me 1 sec. I'm going to take 30 seconds to a minute. Let me see if I can just stop that because it's really annoying. Lock meeting. All right. No one else can join. All right. I have locked the meeting. So hopefully that makes it easier for the rest of the group. If people wanted to join, they had to join within 15 minutes. That seems reasonable. So apologies again, folks. I wasn't sure if you guys could hear it. I'm glad I asked. Let's get back to this and hopefully in silence. So with that said, let's go back to the meeting here and jump in. Okay. So we're going to imagine that you have just arrived at your job. You're at a startup. And you've just finished so the business has just finished its first year. So the business has been around for a year, and you're arriving, and your job is to build a simple financial model for them. And we need to build the financials out. We need to lay out the numbers and get this model ready for the boss, CEO, CFO, VP of finance, whatever the case may be. We need to build a simple model, and that's kind of the task that we're given when we land at the startup. Again, I want to emphasize and reiterate, we are at the end of year one. Year one has already transpired in the past. To that point, what I'm going to do is jump into the startup year, and startup period, and we're going to lay out those numbers first, and then we'll move on to the kind of the rest of year one. So in the startup period, with most businesses, there's some investor contribution, some borrowing that happens, and then in addition, you have to buy things to kind of set up the business, and that's really what we're going to start off modeling here in our Excel file. So that's going to be the exercise, is really kind of laying all this out. But so that's the exercise. Sorry, jump the gun here. That's the exercise we've been asked to do. That's what the boss is going to ask us to do. But before we get into the actual nuts and bolts of Excel, I wanted to show you what this is in real life so that we have a sense for what we're laying out in Excel. Just punching numbers into Excel is often not super helpful if you don't have the context of what's actually happening here. So these are the transactions that we're going to punch into this Excel spreadsheet in just a second here. So we'll imagine that the company was started by the CEO, and that the CEO is going to fund the business. This is going to self-fund. And so the CEO invests $100 of their own money in the business. And then they have a banker, a lender, who says, in addition to your $100, I'll lend you $100 as well, but you need to pay me 10% interest on that money that was borrowed. So this is going to be interest expense that you have to pay, as the company has to pay as the borrower for that loan. We take that money, the $200, and then go set up our business to have a business. This is going to be a cookie business, by the way. We go to a cookie supplier, and we get our money in the bank. We go to the cookie supplier, and we ask them if we can buy cookies and that we're going to resell. And they say, sure. and this is a key point to understand here, they say, sure, we're going to give you $50 of cookies, or you can give it as cookie dough. Cookies doesn't really make a huge difference. But the key thing is we only have to pay for half of it up front. So we're going to pay $25 of it right now, and the other 25 when we sell those cookies. And that's always going to be the structure with this supplier, which will be our only supplier, just to keep things simple. So whenever we have inventory, we're going to be lent half of it by the supplier, and the other half we pay in cash. So just want to make sure, hopefully that's clear. And then lastly, we're going to go to an equipment seller because we need a cookie stand. And let's do our animations here. So we got our cookies. And then lastly, we go to the equipment seller because we want to buy a cookie stand. So we go to the equipment seller and say, we're looking for a cookie stand. They say, I've got you covered. You can buy this cookie stand from us. It has a 5-year life, and you can pay for that in cash for $50, and the cookie stand is yours. So we pay the equipment seller here for the cookie stand, and now we own a cookie stand. And now we have kind of the pieces that we need to run this business. So these transactions that you see here are what we're going to lay out in Excel as kind of the startup of our business and the start of our financial model. I should mention before we dive into this that the first really 2 exercises, so the startup period and the year 1 period, really more reflect entering in historical financials as opposed to building a proper model. It's really when we get to year 2 and year 3 that you'll see how we actually build sort of a more traditional model. But that you have to get kind of past these initial steps of just laying out the numbers first before you can get there. So with that said, I'm going to jump ahead, and we will hop into our first exercise of the night, which is laying out the startup numbers for our financial model built here. And looks like Leo sent the materials. So that said, I'm going to pause the screen here for a second and pull up my model. And unpause. Okay. So when you open up the intro to financial modeling file, you should see a multi-tab file, a multi-tab Excel file here. And while people are getting the file up, just a few notes about this file and really any of the files that you work on with Financeable. So we set up our files around kind of a tab by tab build where there's a progressive build up to an end answer. So if you look to the far right here, if we look at year 3, we're going to have a full model with all the numbers built out. We're starting in tab 1 where we're just kind of laying out the initial numbers. And so I bring this up for really 2 reasons. 1, to note that that's the structure to begin with, but then 2, to note that if you're working through any of these exercises and you get stuck and you're wondering, okay, where do I go from here? Or did I get it right? I did the exercise. Am I right here? Or maybe you had to step away and you need to come back. That's totally fine because the answers are always on the next tab. So for example, if we're working in tab 1, your answers will be in tab 2 and so on and so forth as we carry on through the exercises. In addition, in the Excel, the only thing we're filling out in each of the exercises is our blue shaded cells. So you don't need to fill out anything but the blue shaded cells in that exercise until we move to the next exercise. And then beyond that, to the point of making this more manageable, particularly for the folks here who are just getting up the curve and are still learning about accounting or maybe don't know about accounting, we've laid this out in more plain English terms, more sort of terms that you wouldn't need an accounting course for across the board for all 3 financial statements. So again, the income statement, the balance sheet, and the cash flow statement. And if you look up above, you're going to see that there are some hidden columns here. If I click into those columns or any of these columns, you're going to see that the traditional kind of accounting name is in the column next to those labels. So there are 2 things here. One is if you are more familiar with accounting for one reason or another, you can pop this open and see the answer. But more so for the folks who are new to this, if you go through this exercise and you understand kind of what we're talking about, but also bridge to accounting, you can simply pop this open and see the sort of more traditional names you'd see in an accounting textbook or a traditional financial model. Beyond that, and similar again to all of our courses or all of our Excel files, we have instructions for you step by step. So in this particular exercise, I'm going to click the instructions open right to the right of the cash flow statement and also to the right of the balance sheet, just to show you that they're there. I'm actually going to bring them back, but we have instructions for both the cash flow statement and the balance sheet that we'll be using here. For right now, I'm actually going to start over on the cash flow statement. So I'm going to close the balance sheet and we're going to start working through the steps of this exercise to really start building out the basis of our financial model. Now, So, are there any questions in here? If there are any questions in the chat, please do let me know, folks. And please, please again, if you have a question, just DM me the question. I'm happy to answer it. I'll answer it anonymously. The first thing to note here is as we start building out a model, again, keeping this kind of plain English, if you think about any business in the history of businesses by and large, they really have three cash flows as a whole, and these map to the three sections of the cash flow statement. So every business makes money, they reinvest that money in some form or another, and then they will raise money in and out from lenders or investors. And those are really the three sources of cash in and out for any business. So the operations of the business, reinvestments, and then money in and out from lenders and investors. And that's what you see in a cash flow statement. Now, in accounting, we have more formal names for this, so cash flows from operations, investing, and financing. But really what we're seeing here to begin with on the cash flow statement is how much money the business made, how much was reinvested from the money the business made, and then how much money was raised or paid back from lenders and investors. And we're going to kick this off by really anchoring to cash, because cash is the easiest thing to see and to tangibly feel as we're thinking about a business. And to that point, I want to start our exercise here, and I'll do with each of these a couple of steps, and then I'll stop. I'll let you try it, and then we'll kind of carry on here. But I want to start the exercise here with just mapping to the change in cash for the business. So the change in cash for the business is going to be what we've made, our reinvestments, and our funding. And so what I'm going to do is move to cell Y26 here, and I'm going to press plus, and then I'm going to go up to business cash flow, plus, again, reinvestment, plus, again, to business funding. And before I get the question here, someone's asking a question about subsidies. I'm happy to answer that on a sidebar. I want to keep this to kind of the basics tonight for the main session. Happy to dive into that on a sidebar. What was I going to say? So before I get the question here, so there are two ways to enter things in Excel. Actually, undo this for a second. You can do equals or equals minus to enter things in. I'm doing plus and minus. You'll see me doing that throughout the evening. And the reason for that, just from a modeling best practices standpoint, is if you want to move quickly in Excel, you are often going to be using your number pad on the right of your keyboard. And if you want to enter things quickly, you typically are going to get in the habit of using your plus and minus keys to enter things. It does the same thing as equals and equals minus, but you don't have to keep reaching back across your keyboard in order to enter things into Excel. And so just to kind of explain why we're doing that, that's kind of the idea. And so no equals minus, it's just going to be plus cash flows, plus reinvestment, plus business funding. I'll press enter there. So that's going to give us our change in cash. By the way, if you want to examine a formula, as I'm doing right now, it's just F2. Press escape to get out, F2 in, escape to get out. I'll give Excel comments throughout just to try to help you guys see what we're doing. And then the next thing I'm going to do, and we can open the instructions here if it's helpful, is I'm going to go over to my balance sheet. Remember, the balance sheet reflects the accumulated transactions of a business, and I'm going to link to that change in cash that we just created. And the idea here is, as we enter in transactions, as you'll see in a second, we want to make sure that all of those transactions are captured in our cash. So that's why we're linking it up. I'm going to give you a second to do that, and then I'm going to jump to the next thing. Again, questions around this, please fire away. Okay, so if we look up on the upper left-hand side here, remember the owner of the business invested money in this business, and that's how the business really started before we had a lender. And that brings cash into a business that goes into our bank account. So what we're going to do to start things off here is we're going to reflect $100 of investment from the owner of the business. And that $100 is real money into the business. So you can see our cash balance went up. But if you look over at our balance sheet, by the way, the balance sheet doesn't balance. Now, sort of a silly comment, but balance sheets have to balance. If they don't balance, they're not balance sheets. What we're doing really here is reflecting, what we own and how we paid for it. In this case, what we own is some cash, and how we acquired that cash was the owner of the business lent or invested, I should say, the money into the business. So in order to get our balance sheet to balance back with each of these transactions, we're going to have to make offsetting adjustments in the balance sheet. In this particular instance, what we're going to do is take the $100 the owner invested and link it over. So I'm just going to grab it directly from the cash flow statement for now and pull it in. And you can see the balance sheet is balanced out. So I'll give you again a few seconds to give that one a shot, and then we'll jump ahead. Next, we took on a loan for the business. So that loan gave the business money. So that's going to be money in the door. So we're going to put in $100. And again, you can see the balance sheet's out of balance. We acquired another $100 of cash, and we need to reflect the offset to that. So what we're going to do is we're going to pull in the bank loan to our balance sheet to reflect the fact that the way we acquired that $100 of cash was by borrowing. It's now we owe someone that money in the future. And then moving from, actually, again, sorry, I'll give you guys 30 seconds to enter that in. Getting a little too excited here. So again, $100 into the business, $100 borrowed. And right now we're just entering in historicals. We're not really building a formal model just yet. We're just kind of getting the numbers in place. Next, we acquired inventory. But the thing to understand, or to remember, I should say, about the inventory is that we acquired $50 of inventory, but the lender said, the supplier said, you can pay me half of that whenever you sell the other half of the cookies. So we need to reflect the fact that we had to put out $50, technically speaking, up above in our cash flow statement. This is our operations of the business. But our lender gave us 20, or our supplier, stop calling the lender, the supplier of the cookies gave us $25. So the net cash outflow for the business, if you look down at the bottom right here, was $25. Let you all punch that in. It's negative 50 again for the purchases, and then plus 25 for the money from suppliers. Okay. Now, once again, we're out of balance. So we have to get this balance sheet balancing. Again, if it's not balancing, it's not a balance sheet. So we're going to go back over to the balance sheet and link this up. So we now put out $50, but we acquired in return inventory. So we need to reflect the inventory on our balance sheet. Now the catch is this is a negative over on the right-hand side here. We need to flip the sign to reflect it as a positive. So I'm going to type negative, and then I'm going to move over using my arrow keys to grab the inventory from suppliers. So we now own that $50 of inventory as a business. On the other side, we borrowed $25 that we now owe the cookie supplier to the extent that we sell these cookies. So I also need to reflect the fact that I now owe this $25 to this cookie supplier when I sell. And when I do that, you're going to see again the balance sheet balances out. And then lastly, we acquired a cookie stand. So we have to have a place to sell our cookies. So we're going to reflect the fact that we put out $50 for the cookie stand itself. So negative 50 here. We're out of balance again. And we need to reflect the fact that we now own that cookie stand on our balance sheet to make everything balance out. So we gave up $50 of cash, but we now own the cookie stand. So we're going to reflect the cookie stand as a positive on the balance sheet. And again, we're going to flip the sign here because this needs to be reflected as a positive. So it's negative. And then we go over to our equipment purchases, enter. And that completes the first exercise, which is setting up the business. So what we did here is we looked at the cash. Again, to recap, the cash in and out. Again, it's how much money the business made, what we reinvested, and then money in and out from lenders and investors. And all of those things have to be reflected in our balance sheet, or we're not going to balance out and we end up with an issue. So what we have now is basically a business that we can now run. And once again, to reiterate, again, for the folks that are newer to accounting, what the balance sheet is really showing us is the accumulated effect of all the transactions that we've made. And you'll see that kind of continue as we go through this whole exercise. I'm going to stop there for two reasons. One, to give anyone kind of 30 seconds or so to wrap up if they need to. And then two, if there are any questions, fire away in the chat. I'm happy to answer them. Actually, while we're waiting, I'm going to unlock the meeting and see if anyone joins, and then we'll relock the meeting. All right, let's jump back on the slides now. All right, so back on the slides, and we're going to now hop into year one and see how those numbers lay out beyond just the startup period. So just jump ahead here. So in year one, we run the business. Well, imagine the CEO, I should say, runs the business, and they sell to customers. So we're going to have sales to customers, costs associated with those sales. And then as we make sales, we need to replenish all of our supplies and make sure we have enough to sell in year two. And so that's what we're going to lay out in year one. And that, again, to reiterate the point from earlier, this startup period, the year one, are really kind of reflecting more historical numbers. We'll get into the projections after we enter this in, but kind of have to have a baseline to start with. So before we jump ahead, and this is more, again, for the folks that are either new to accounting or haven't seen accounting, there's one quick topic I have to introduce here because otherwise this next part won't make any sense. And that is the topic of what's called capitalization. So in the accounting sort of system, if you will, there are kind of two ways to capture expenses. The first way is just simply expensing. So let's imagine you're running a business that has a factory that has an electric bill. And in a period of time, we have an electric bill that's $300 and we have to pay that bill in the period for that particular electric bill. We'll put out the money and we'll reflect an expense for that. The problem, and that's very easy. The problem, though, arises when you have a situation where you have something that isn't just an expense that's incurred in one period, but rather that extends over multiple periods, particularly over multiple years. And in that case, we have a slightly different system for managing that expense over time. And without getting into the nuts and bolts of it, accounting's entire objective is really to get to the substance of transactions, not necessarily to the cash. That's what I mean when I say the income statement reflects substance. It's not necessarily the money that went out the door in all cases. And the way we handle this, particularly for assets that have a longer life, or what are called formally long-lived assets that have a life beyond 1 year, is we capitalize them, as a term. And as an example of that, if we imagine we bought a factory with a 3-year life for $3,000, we would clearly have the cash flow at the outset. We have to pay for the thing, right? So the money goes out the door, but we don't expense the entire thing in the first period. So what we would say is, okay, we're going to move the cost of acquiring this factory to our balance sheet and then spread it out over its useful life. And so to walk through how that would work, we would, in year one, expense, in this case, 1/3, because that has a 3-year life, 1/3 of the cost of this factory. So we'd expense $1,000. And the factory's value on the balance sheet would then go down by that same $1,000. And then in year two, another $1,000, the value goes down again. And then in year three, again, another $1,000, and it goes down to zero. But the overarching goal here is to really try to match up the expense with when we're utilizing the asset. So that's what you're going to see in the upcoming slides in one or two parts, or one or two spots in the model. And I wanted to clarify that. And I should mention that as a whole, we call this capitalization. But when we think about that expense that we incur in a given period, so as we wind, for example, the factory down, for a physical asset, we call that expense depreciation. And if it's a non-physical asset, so if let's say it were a patent or something along those lines, we would call it amortization. They're just fancy names for winding down the cost of things in proportion to their life. And you're going to see that in the coming exercise. The one thing, just stepping back from the nuts and bolts of this, is I'll answer this question. I'll answer it in just a sec. The one thing, stepping back, to really grasp here, and if you can grasp this, it'll save you a lot of frustration later on, is that there's just a disconnect here between when the money goes out and when the expense incurs, or is incurred, I should say. And so with accounting, that's why we have a cash flow statement, by the way. With accounting, we record the expense substance. So the substance is I incurred 1/3 of the expense, but the real money flew out the door on day one. And there's that disconnect between the two. And that's actually what we're dealing with in the cash flow statement. Someone just asked here real quick. So what's the difference between the cash flow statement and the balance sheet? So I'll try to quickly answer that. So think of the balance sheet as like your bank account. The balance sheet is basically accumulation of transactions. So any business is going to have all sorts of transactions that go in out. They're going to have sales, they're going to buy things, they're going to sell things. And the balance sheet basically shows us at a point in time what we own at a point in time, and then how we paid for it, whether it was borrowing or effectively investment. So we call that liabilities or equity. That's the balance sheet. The cash flow statement just shows us money in and out over a period of time. So how much actual dollars went in and out. And the reason we have that statement, going back to the point I was just making, is in the accounting world, I'm not going to go too far off the path here because it's a little beyond the scope, but if you go into our accounting course, you'll see this in more detail. Basically, the goal of accounting is to see the underlying transaction, like what's the root transaction, regardless of when cash flowed. And so it doesn't always capture the dollars in and out. And so we have this cash flow statement to say, okay, well, that's great, but like how much money actually came in and out of the business, because we need to understand how cash actually flowed in the period too. So hopefully that answers that question. And then if not, please keep asking, guys. I'm happy to answer questions. But with that, I'm going to jump ahead to the next slide, and we're going to talk through really the operations of the business in this year one period and kind of what happened. So, and to do that, I should say, we're going to reflect this in the income statement, just to show you what we're seeing when we see an income statement in real life. So in year one, the company went out and started running the business, and they first sold to customers. So customers came along and said, we're going to buy cookies from you. And they paid us for those cookies. We delivered the cookies. And as that happened, we recorded what we call revenue, which is just effectively money in from customers. And we also have to record the offsetting cost of providing that sale. So the cost of the cookies that we sold to the customers. So we're going to get rid of our customer here. We also have employees of the business. So we have employees who help us run the cookie stand and help keep everything running. And so we have to pay them as well. So the employees need some money from us. And so to reflect the payment of that reflect the payment, I should say, to the employees, we need to incur an expense there. And so the income statement is going to reflect the money we made, less the cost of the cookies, less the cost of the salary we paid to our employees. Now, if you were running a regular business in the absence of any knowledge of accounting, you would say, well, I made $45 in this period. The thing is, again, with accounting, it has these kind of funky rules that we don't go too deep into, but just the gist of it is you have disconnects between the money that actually went in and out, and then also what accounting says, which is the underlying profit. And from an accounting perspective, remember that we bought that cookie stand and the money flowed out on day one of the year. Or we would say it could be the day before the start of the year, we'd say, to make it easier. And we need to expense 1/5 of that cookie stand. So the cookie stand cost us $50, and we have a 5-year life on that cookie stand. So we're going to record a $10 depreciation expense, which lowers our profit. Now, that's not money out the door necessarily. We actually made $45 here in essence, but we need to record that to get to the true underlying profit of the business. We also we took on debt, and we have to pay our lenders. So our lenders come back and say, hey, it's great that you're running now. Great that things are going well, but you borrowed $100 and you said you would pay 10% interest on that. So we have to record the expense that goes along with that. And so we record $10 of interest expense. And then the tax folks, the IRS in the US, comes along and says, hey, that's, again, awesome that things are going well, but you owe me money as well. And we have to pay them 20% of our profit. And ultimately, we have to pay them before we get to take money home for us as the business. So in the end, when we talk about an income statement, this actually hopefully answering the question that was asked earlier, this is what we're talking about. It's basically, what do we sell? What were the expenses, including accounting expenses, all the way down to our interest expense on any debt, and then any taxes that we had to pay to, again, in the US, the IRS, different authorities across the world, but the tax authority. So that's an income statement in a nutshell. And these are the transactions that we're now going to record in our Excel file in the next exercise. So to that point, the boss comes back and says, all right, let's start setting up the year one financials so we can get them in place before we start building our projections. And they've given us the data, which we largely had from the prior slide, but there are a couple additional things to note here. One is that we're going to, at the end of the period, replenish our inventory up to $60. So remember, we sold $35 worth of cookies, so we need to get our inventory up so we can sell to more customers. So we're going to assume that inventory ends at $60. And that that once again, the supplier is always willing to give us half of that at a given point in time in advance of us selling. So whenever we sell the other half, we have to pay for it. But if we end at $60 in inventory, we will, at that point in time, owe the inventory supplier $30. Okay. So that's what we're going to lay out in the next part of our model. So we're going to hop back into the Excel file. And we're going to start building out our year one financials. So again, I'll give you all a second. Leo or Kieran, if you all could share the links in the chat, just so everyone has them handy. I appreciate it. And while we're waiting here, just once again, if you get stuck here, the again, in terms of terminology, the formal names for all these accounts are hidden in each of the statements, so you can kind of cross-reference. To that point, what we're going to do, and I'm actually going to zoom into the file a little bit here. So to zoom in, it's going to be Control Alt and then plus to zoom in, or you could go to View and then you can go to Zoom if you want to use your mouse. And what I'm going to do is start laying out, pop open my instructions here, laying out just to start with the transactions that we saw on the slides, basically those sale transactions, the expenses, and so on, so that we can see them in our income statement as a starting point. Before we do that, just two quick calculations. So we purchased the cookie stand, remember, for $50, and it has a 5-year life. So if you record, we're going to calculate, I should say, the depreciation expense, which is going to be what we paid for the cookie stand, and then a 5-year life. So we're going to divide by 5. So we were going to incur $10 of depreciation expense in a year. And then on the loan, we are going to incur $10 of interest expense as well on the loan. So it's going to be $100 times 10%. Okay. Down below, we'll then start building out our income statement, really what we saw on the slide a second ago in those transactions that we saw. So to do that, we're going to start pulling in the data from up above. And actually, after I do the first one, I'm going to make a quick note about modeling best practices here. So I'm going to press plus, just like we did before, and pull in revenue. And when I do that, what you'll notice here, just as a quick aside, is that I've got blue font for the number up above, and then black font for F25 here. And that's actually very intentional. It's just a quick note to make. So whenever you're working in finance, hard-coded cells, meaning a hard-coded number entry like this, is typically going to be colored with blue font, whereas a link to another cell or any type of formula that's actually a calculation in the formula is typically black font. Next, I'm going to pull in my costs, which are up above. I'm going to make the cost negative though. So I'm going to press negative, and then I'll move my cursor up using my arrow keys. I'm going to grab cost of cookies sold. So the cost of cookies we sold to our customers. And then I'm going to grab also the salary expense, again, with a negative in front of it to reflect it as a negative. Once I complete that, and I'm going to go through to the end of the income statement just to foreshadow here, and then I'll pause and let you all try to finish the income statement, and then we can carry on. But the next item is depreciation. So I'm going to pull in depreciation again as a negative. Interest again as a negative. These are all expenses. And then the last thing to do here is to calculate taxes. And you can see out to the right, we've got the instructions. Our taxes are just what percentage of our profit do we pay in taxes? It's just like sort of your personal taxes. So we'll take the negative of the tax rate, 20% in this case, times taxable income, which is going to give us the taxes that we owe for that particular year. And so we're just pulling in the numbers here one by one. And when you're finished, what you should have is what you see up here. I'm going to pause and give you all, call it close to a minute or so to give it a shot and kind of pull these things in. And then we'll carry on. So someone's asking here where I got the -5 from taxes. The -5 here is simply my taxable income times the negative of my tax rate. You could put the negative on either side, but what I'm saying here is I'm paying 20% of my income in income tax. And again, just to go into a cell, it's F2, escape to pop out. It's F2 in, escape out. Another 20 seconds or so, 30 seconds maybe. Jump ahead. And actually, to the point of the question that was asked, if you all ever get stuck, actually, the top is, I guess, maybe a bad example. I'm giving one set of instructions for all of these to really pull from the top, but you can always pop open the columns here to see the instructions for each of the calculations if there's a calculation for the most part. All right, so from there, I'm going to close the instructions here so we can move over. I'm going to pop open the instructions for the balance sheet here, and we're going to go to the next step, which is pulling in our ending balance for inventory and for the money that we owe to the supplier, just to start off with here. So I'm simply going to go up and grab inventory, enter, and then for the money owed to the supplier, again, plus, and then going to the money owed to the supplier. Just pulling those two in so we can reflect them. And from here, I actually have a question for the group. I'd love to hear some guesses if y'all have any. So let's imagine you're working on the job, you're working through this, and the boss comes by and says, okay, how much money did the business make? How much cash came in? I'd be curious if anyone has any guesses as to how much money this business made based on what you're seeing here. If you want to DM me the answer, if you want to send it to everyone, that's also fine. But we'd love to see some guesses for how much money this business actually made in year one. Let's say $20, okay. $20. Any other guesses? I appreciate y'all punching this. Get a couple DMs as well. 20 plus 10, okay. Got another guess here. All right. When you look at this, you want to say 20, right? You're like, okay, well, it's right there. There's $20, right? Someone here said, actually, what I would say is the right answer, which is 25. And I'll show you how I'm going to arrive at that answer. Again, the idea with accounting is substance, not necessarily cash. So, and nice work for the person who came up with a 25. So the short story here is this reflects, this reflects the substance of the transaction is not necessarily cash. And as a very specific example of that, if you go back to the depreciation that we talked about earlier, we're assuming the startup period is kind of its own period. Technically speaking, if you were putting together financials, they probably would come together, but we're keeping it as kind of a separate period for now. And the thing to understand here is we actually purchased the cookie stand out to the left. Someone's asking, depends on profit or actual cash flow. That's exactly the question I was getting at. Nice work. So we bought the cookie stand over here. So that's when the money flowed. And in this period, we incurred a $10 expense as a starting point. That's not real money out the door. It's just something we have to do for accounting reasons to kind of match up when we think the expense was actually incurred. It's more of a conceptual thing than it is an actual cash outflow. So to that point, over on the right-hand side in our cash flow statement, we have this first section of the cash flow statement, more formally called cash flows from operations. But the idea here is, let's take this number that isn't really necessarily cash and actually work to how much money actually came in the door. And that's really the goal of the right-hand side here. So I'm going to show you how we work to the $25 that someone else came up with here, that one of the folks came up with here, I should say. So to do that, what I'm going to do, and you can pop open the instructions as well. Just go back over. What I'm going to do is pull in the net profit. And to begin with, what we're going to say here is, we incurred within that $20 is $10 of depreciation. And that $10 of depreciation is not real money out the door. So we need to add it back. So I'm going to take the negative of the depreciation, press enter, and add that back. So that's where the 20 plus 10 guess came from, by the way. So I'll give you a second to punch that in. So it's negative of the depreciation to basically add it back because it's not real money out. And then this next part, I'm actually going to ask you all to just trust me, and then I'll explain it. So in addition, for a second, and then I'll explain it. So in addition, we purchased some inventory, and we actually borrowed incrementally from the supplier who provides us with that inventory. To reflect those two items for right now, what I want you to do is go over to your balance sheet, and we'll do a plus again. And I'm going to go over to inventory and grab the prior year balance and subtract the current year balance. And effectively what I'm saying here is, inventory on a net basis cumulatively went from 50 to 60. If you imagine you had to go buy $10 of new inventory, that's money out the door. And that's kind of the starting point for thinking about this. So I have to reflect the fact that on a net basis, $10 went out the door. Conversely, I actually borrowed an incremental 5 from my supplier. So for the owed to supplier component of this, I'm going to take the $30 that I have for the supplier, and I'm going to subtract the prior period balance to reflect the fact that I actually borrowed $5 incrementally. So on a net basis for those two items, just looking down at the bottom here, I have a negative $5 outflow in addition to the other two items up above. So when you look at this all in all, what you'll see is the company actually generated $25 of cash, even though from an accounting perspective, we saw $20 of profit. And that's really often, again, the disconnect between these two is one's really kind of substance. This is how much money came in. So I'll give you all a second to lay that out, and then I'm going to show you what's going on there. Okay. So someone asked a good question here, which is, and maybe I'm not asking this from the question. Oh, so I think I misunderstood the question here. So the question is, why do we start with a cash flow statement on the first year, and then kind of flip everything on the second one? So we started. It's actually from just more teaching perspective, really quickly. So on the first one, we started over here because a lot of folks here are not coming in with an accounting background, and I think it's easier to just see money in and out as a starting point. But then, and there's some other complexities here, but when you get to proper modeling, what you're going to see is something that's more like what you see in year one, and particularly as we get to year two. I'll flag it as we go, kind of what becomes sort of more proper and traditional modeling. But just from a teaching past experience, from a teaching standpoint, start with like real money and then work to the craziness as a short story. So someone's asking AL28. Let me just go here. And then, sorry, getting a few questions here. Yeah, so Daniel, I will come back to your question. Actually, that's where I'm going to go next. There's a more sort of complex answer to this, starting with the simple one, and I'll come back to the complex one. Let me just here. Okay. 12. So someone asked is great questions here, by the way. Thank you guys for the questions. So someone asked another question here, which is, could I grab the depreciation from up here as opposed to down here? The short answer is, particularly for something simple like this, mechanically, that's not the end of the world. But really what you should probably be doing is linking into your model as opposed to your kind of back to the original assumptions here. We're kind of building a model that flows cumulatively across the three statements. So I'd probably link back to the model. Mechanically, it's not going to make a huge difference here one way or the other, by the way. And then for AL27, again, I'm going to do this and then carry on here. So AL27, what I'm doing is I'm taking the prior period balance minus current period balance. And if you look at, again, folks, if you pop open the instructions here, you're going to see the answer or the calculation you need over on the right. So to that point, I'm going to teach you all a little rule that you can basically learn and effectively forget everything I'm about to tell you for the next 3 minutes, or you can try to dig into the weeds of this and see if that makes more sense. But the short story with this is when you look at the current asset items in this section of the cash flow statement or the liability items, the rule of thumb is for asset items, it's prior minus current for all assets. And then for liability items, it's current minus prior. So as an asset increases, we're putting money into the system, but as people lend us money, it's money coming out of the system. So prior minus current, current minus prior. And if you just memorize that rule, and we actually harp on this in the financial modeling course in more detail, but like that actually will get you pretty much most of the way. For anyone who wants to understand kind of more what's happening under the hood here, there's a little diagram I've put together down below just to explain kind of what you're seeing to the extent this is helpful. And for anyone who is new to this, if this makes no sense, that's completely fine. You don't have to know this to know modeling, but just to show you guys what's happening here. So just to recap what we did here and how we effectively ended up at the $25. So we have this dynamic with inventory where we started at 50, we ended at 60, right? We sold $35 of cookies. Well, if I start with 50 and I sell 35 of cookies, I'm down to 15 and I have to get back to 60. The way you get there is you purchase new cookies from the supplier. So if you think about real life here, in real life, the cookies that we sold, we already actually own them. We didn't need to buy them. But in real life here, what we did was we replenished our inventory. That was the real cash outflow here of $45. So in effect, what we really need to capture from inventory as a whole is $45. The problem is that we only have $35 reflected in our income statement. And so we need an extra 10. And that's really what that difference is reflecting. The offsetting factor, though, is this money we owe to the supplier, what we call accounts payable. That started at 25 and went to 30. But in real life, I actually can pop this open. Sorry, pop this open so you can see that it's cash in and cash out. In real life, what's happening here is we sold the 35. Well, we sold the cookies. Now we have to pay the supplier for that portion of the other half, I should say, of the cookies that we bought before. And then we borrowed again when we bought the 45. On a net basis, when you just plug all this together, $5 came in the door from the supplier. So on a net basis, we got $5 from the supplier. So again, stepping back from the numbers, what really happened here was we had to come up with $45 for new cookies in total, but the supplier cumulatively lent us 5. So we really had to only come up with $40. So the 45 minus the 5. And we recorded 35 of expense. Well, if you want to go from 35 of expense to 40, we need to reflect an incremental 5. And that's what these two simple calculations over here are doing, just to kind of, it's a simpler way of doing it, but that's what's happening under the hood. So in total, when you pull this together, we had a $20 profit. In total, we have to add back the non-cash charges. That's our depreciation. And then we reflect the net impact of our inventory and accounts payable to take our $35 expense that we've recorded up above to $40, because that's the actual money that net went out the door. And that's how you get to the $25. Now, again, particularly if you're new to this and you're like, I have no idea what's going on in what you just said, that's actually completely fine, because from a modeling perspective, particularly at the outset, all you need to understand, and a much easier way to do this, is for the items in this part of the cash flow statement, for asset items, it's prior minus current, liability items, current minus prior, and that's the end of the story. Okay. I'm going to stop there before we move ahead. Any other questions that I can answer? Anything I can clarify? I know that was a lot. Okay. All right. So from there, we're going to continue with our steps here. So we just completed step 8. So I'm going to move over to step 9 here. And we're going to calculate our ending balance for the equipment account. Now, if you recall before, with the equipment account, we just recorded a purchase. But now we have this dynamic where we have depreciation that we need to reflect as well. So if I buy the cookie stand and I expense 1/5 of it, I need to lower the balance for that account by that amount, because now I've used up 1/5 of the cookie stand. So for this particular account, I'm actually going to scroll over here. So you can see it. Yep. For this particular cookie stand, I need to reflect any purchases I've made. And for right now, I'm just going to keep it simple. You could, technically speaking, you should go over to the cash flow statement, if this were a proper model. For right now, it's not fully proper, and pull in any purchases. There are no purchases. We'll keep it simple for right now. What you're going to do, because we have no purchases, is just take the equipment and we're going to subtract out, plus, it's a negative. We're going to subtract out the depreciation, because we now bought this cookie stand. We used up 1/5 of it, and we need to take that balance for the cookie stand from 50 down to 40. So I'll let you all take a second to do that, and then we'll jump ahead. And again, folks, as we go, please ask questions. I like questions, so happy to answer them. Then down below, we have our bank loan. So we didn't borrow any new money. We didn't pay back any of the loan this year. So what we're going to do is we're going to take the bank loan, and we're simply going to add in the amount that we borrowed, which is 0 in this year. And it's going to be an ending balance of 100, because we didn't change the loan. Okay. And then last but not least here with these accounts, we need to reflect the cumulative investment by the owner and it's both cumulative investment by the owner, but cumulative profit of the business as well, is this last piece. So what we're going to reflect here is the prior balance plus any new money invested in the business, which is going to come from the cash flow statement. So any money that came into the system, plus any profit the business made in the period. And I should note here, you'll see there's actually a line here that says minus dividends, if any. So dividends are payments to the owners. So extraction or distributions of cash to the owners. And if we had those, we'd reflect them. We don't have that line just yet. We're going to add that in a little bit. So for right now, it's just the money that came in from any new investment by the owners, and then the cumulative or the profit for the period. All right. With that completed, let's go back to our cash flow statement and add up how much money flowed through this business for the period. So what we're going to do is we're going to take the business cash flow, which is the money the business generated. Remember the $25. Any reinvestment, we made no reinvestments in this period. And then any money in and out from lenders and investors, none of that this period. So the cumulative cash flow here is $25 through the business. We started last year. We started the year. We ended last year with $125, and we had a net cash flow of 25. So we'll take the prior years or prior periods ending balance, and then add to that the change in cash for the period, and watch the balance check now. The balance check goes to 0. And that last little bit, the cash piece of this really closes the loop on all three of these statements. And now we have really kind of a connected flowing three-statement, actually the start of a three-statement model. So I'm going to stop there for a second, let you all make these connections. And again, if you get stuck, the answers, first of all, the instructions are here. The answers are on the next tab as well, if you want to see what it should look like. I'll let you all do that. And then I want to show you something and sort of where this is already really a financial model at this point. So before we jump ahead, let's actually take our revenue up. Now, you wouldn't probably do this, and you'll probably see why shortly, because we need to attach everything to the growth in revenue. But let's imagine we said the company generated 120 in revenue in the year as opposed to 100. If I press that in here, you're going to see that flows through all three financial statements. So we have a different profit, we have a different cash generated by the business, and then ultimately a different ending balance sheet because different amounts flowed through the three financial statements. So we have the start of a financial model. It's not using all the best practices and sort of in the most dynamic way. And that's where we're headed with this, but we're effectively at the start of this. Also, to hopefully also close the loop on the question that was asked earlier, I want to try to make sure it's 100% clear. So we're effectively working to what looks more like a traditional model. The first step here is just trying to orient people to the three statements and kind of what's going on, at least particularly starting with cash, and then how these things accumulate. So this piece is not building the model itself. It's just kind of getting everything set up. As we move through the tabs, what we'll see is something that looks more and more like a model. And really the last tab is really a mini model. So hopefully that makes more sense. Again, any questions, I'll pause for a second and then we'll hop back into the slides. Okay. Alrighty. So with that said, let's jump back into the slides here. One sec. Someone just asked one question. I'm going to try to answer this real quick. Just make sure. Okay. So I'm simplifying. So the question here is explain this owner investment and profit thing. In, again, proper accounting, this actually would break into two separate lines. One line would be common stock, which is the money the owner invests. And as the owner invests more, that goes up. Technically, they can repurchase. It can also go down. That is owner investment. And then the profit piece of it is really the accumulation of all the money the business has made, less any dividends paid. Now I'm combining the two just to kind of keep it simple to start with. But they're really kind of two separate accounts. One is like money in and out from the investor and money made by the business, but they're collectively, and that's why it's combined here, they're collectively referred to as the equity. So the equity, the ownership of the business. That's why they're combined here. So hopefully that answers that one. If it doesn't, let me know again. I can try to answer it a different way. But with that said, I'm going to pause and flip back. Okay. All right. Flip right back to the, there we go. Okay. So At the risk of beating a dead horse here, I want to just quickly walk through everything from top to bottom, from revenue down to the cash the business made, just to kind of voice over what we were doing just now. So for the business in this period, we generated $100 of revenue, incurred $35 of cost from selling to the customer, $20 of salary expense, $10 of depreciation. But remember that depreciation is not cash. And that gets us to the accounting profit of the business in the period. We paid interest expense. We have then our taxable income, and then we have to pay taxes on that taxable income. And that gets us to the net profit or net income of the business for that particular period. Now, that's not cash, as we said, because we need to make a few adjustments to that. So to begin with, this depreciation charge is not a cash outflow, so we need to add that back to start with. And then we have this dynamic actually going to the top here where the cookie cost were actually purchased at the startup period. They're not part of this period's numbers. And so we need to reflect $45 for the inventory offset by $5 borrowed from the supplier, again, net. So we need to reflect $40 in total of cash outflow that's not really in here because we bought the cookies in the prior period. So we have two adjustments here. We have a reflection of the fact that on a net basis, we invested $10 more in inventory, but then offsetting that, we got $5 from our supplier. So net, we have -5 additional cash outflow. And when you combine the -5 additional with the 35, you reflect that $40 that went out the door in real life. We didn't purchase equipment. We didn't have any loans. We didn't have any new investment. And that gets us to $25 in net cash change. So that's what we're doing here. And this is really almost accounting to cash flow in a nutshell as an aside. But that's what we were seeing in that last example. Again, I'll pause there for just a sec. If there are any questions, let me know. And if not, I'll carry on. All right, let's jump in. So now we're going to jump ahead and get closer to that kind of more traditional financial model. So with a couple of minor exceptions, which you'll see. So in year 2, we're going to create projected financials. So actually, let me pause here for one sec. Leo and Kieran, any themes or anything that you're getting questions about in the chat that I can be helpful with?
Not so far. I'm keeping an eye out though.
Cool. Leo?
Yeah, I got one question on the instructions for the Excel file. And yeah, to see the instructions for remodel, you need to click the plus button on the top of the columns. So yeah.
Okay, thanks. I'll actually highlight that when we get back to the Excel then. Appreciate it. So now we're going to move into year 2 and lay out our projections for the year 2. So remember, we joined this business at the end of year 1, and the CEO, the boss, is saying, okay, now I want to see what's going to happen in the coming year. And that's what we're going to lay out here. Now we're getting in closer to that kind of proper financial modeling. So at this point, we don't know what's going to happen in the future. And this is really the root of all modeling is we don't know the future, but we want to try to approximate to that in an Excel file. And we've been given a set of assumptions by our, let's say, our strategy team around how fast we think the business could grow, how much cookie costs we would incur as a percentage of the money as a percentage of what we sell to customers, how fast our salary costs should grow. And then beyond that, just going down to the bottom here, and I'll walk through the mechanics of all this in a second with some diagrams. Beyond that, at the end of the year, we replenish our inventory again to $80, and 50% of that, again, is lent by the supplier at all times. And at the end of this coming year, at the end of year 2, we're going to purchase a cash register to make operations a little smoother for the cookie stand. So that's what we're going to lay out here is basically the projected financials for the next year using assumptions about what we think is going to happen. And this is really the root of virtually all financial modeling. It's like, what do we think is going to happen and how can we approximate to that in Excel? Before we get into that, though, I want to quickly, someone's asking here, how are assumptions made? That's something that's like a day-long topic, unfortunately. So I'm actually a course that I'm teaching in early January, if anyone wants to join, business mechanics, that walks through that. I can give some very high-level answers, but it's a very long sort of conversation, effectively. The gist of it is when you think about, let me just pull this back for a second. When you think about projecting out a business, we have to project out the revenue, right? So as a starting point, let's just think about the income statement to begin with. And we need to think about growth. So the first question is, what should growth be? Well, growth is really at a root, a function of how fast is the market growing? And then how much market share does the company have? And then where are they in their progression? That's really what you need to think about as it pertains to market growth. And if you're just to put some real life examples out there, we're actually doing a case with Access Distributed yesterday on Levi's. If I'm looking at Levi's versus Tesla, those three things come together very differently in terms of, the market size, the market's growth itself, your position in the market, and then where the market is and trajectory wise. Is it early? Is it late? That's really what's driving revenue at a root level, but there's just a much longer conversation to have there. And then as it relates to cost, it's effectively one of two things, which we'll actually see mechanically in a second. On the cost side of things, from an operating perspective, it's how do costs attach to incremental dollars of sales? So let's say we could project out our revenues. How do costs attach to those dollars? And usually it's presented as a percentage of the revenue, which is what you're seeing in the second line here. And then with some costs, they're less, what we call fixed costs. They're less attached to the growth of the business, and they might just kind of stay relatively steady. As a real life example of that, let's imagine you buy an insurance policy for your business, and it's just going to be the same cost every year, regardless of size. This may be a silly example, but that kind of cost probably is going to be projected at some growth rate approximating probably inflation over time. And so with cost, it's effectively how does it attach to revenue? And if it doesn't attach to revenue, just how fast should it grow every year? But again, if you're thinking about, again, let's pick some different examples. If I'm thinking about, what's a good example? If I'm thinking about like Microsoft's cost versus, Walmart's cost, really the root question is what business do they run? So if I sell a software business, if I'm running a software business, my costs are going to be very low for the cost of the product I sell. Probably going to have a lot of marketing costs though. If I switch over to Walmart, just to contrast that, I'm going to have a very high cost of what I sell, even though the prices are relatively low, but like I'm selling a physical product. So there's going to be a higher product cost. And I also have a lot of overhead. So there's a different dynamic there. So the root question, and I get this question every time we teach a modeling course, that's why I created business mechanics, is the root question is like, what does the business do? And then we can answer the question. And it's kind of work your way down each of the line items. And then the last piece of this is reinvestment, which is really two things. I'm trying to give us high level answer as I can here. The two things are the investments in what's called working capital, which is the inventory offset by money, roughly speaking, the inventory and those types of items offset by money lent to us. So how much do we have to invest in that and tie up cash over time? And then related to that, reinvestment in capital expenditures, with this business, how many more cookie stands do you have to buy? But if you're thinking about just, again, a spectrum of businesses, and we're thinking about a retail business versus a software business versus a distributor, there's just very different answers. And it's more a function of what the business does than like, what is the answer for all businesses or sort of what's a punchline silver bullet answer. So hopefully that gives a little more clarity. And guys, keep the questions coming, please. These are great questions to ask. I'm just going to keep jumping ahead here, but love these questions. They're really good. So to that point, actually, as we think about projecting out revenue, mechanically, there are kind of two broad ways to do it. There's much deeper, if you get into private equity, if you get into investment banking, you're going to see way deeper answers to this. But as a starting point, and for most models, you're going to use one of two methods to project revenue. One method is year-over-year growth. With year-over-year growth, we take the prior year's revenue and we multiply by 1 plus some assumed growth rate in parentheses. So this will be 1 plus 0.1 for 10%. Gets us to 110. And you assume that growth rate, again, based on those things that I talked about before. On the other side, and we're not going to do this in this model, but you will see this quite a bit. If you actually look at, as an example, Apple's old numbers, they used to actually break out, the number of iPhones sold and the price per iPhone as an example of that. You could, with a company that discloses that information, you could take, well, how much does each unit sell for? And then, how many units are sold? And that gets you to revenue. For this model, we're going to use the simpler version, which is on the top here, which is going to be probably 70% of models you'll come across, which is just year-over-year growth to carry revenue into the future. And again, folks, as we go through this, please ask questions. Happy to answer any questions you have. On the next slide, we're going to talk about costs now. So costs, going back to, again, the conversation from a second ago, costs are going to be projected really one of two ways mechanically. In one way, we basically say, okay, as we sell more, how do costs attach to those sales? So do we incur more costs as we go? And again, just using two different examples, if I have a software business where I incur all the costs for R&D and then I just sell, the software and there's very little incremental cost, it's a very different answer than if I'm selling, a physical product. I'll use Levi's again as an example that we were looking at the other day. They have a physical product. Every time they sell a new pair of jeans, there's a cost attached to that. And so when we think about projecting out cost, it's usually going to be a percentage of sales in one sense, and I'll show you the second in a second here. So in that case, we'd say, what's the revenue in that year? what's the cost percentage of revenue assumption, and then what's the projected cost. Now, again, if the cost is a little bit more fixed, meaning it's not going to grow in line with the business, we'd probably use year-over-year growth, which is exactly what we saw with revenue a second ago, where we say, okay, well, what was the cost? Okay, let's now grow that into the future at some assumed growth rate. And then that's going to get us to the projected year's cost. And these are, again, kind of the two mechanics you're going to see most frequently. Candidly, the top one is probably what you're going to see 70% of the time in most models. So again, I'm going to stop there and see if there are any questions. Okay, let's jump back to the model. Now we'll build our almost model. We're almost there. So let's go to tab 3. We're going to go to year 2 operations, and we're going, let me just jump back. Someone asked a question here. And if my answer I'm about to give doesn't answer the question, I will, I think it'll make actually more sense when you see it in Excel as well. So just more mechanically. So just to explain the cost percentage of revenue, what we're saying is if I sell, let's use the cookies as an example. Let's say I sell a cookie for $10 and it costs very expensive cookies, but a $10 cookie and it costs $5 to make the cookie, right? If I sell another $10 of cookies, presumably it's probably the same thing. So it's probably going to be $5 relative to 10. So it's 50% of the revenue. So when I say, what's the percentage of revenue? That's really what we're getting at, is how do those costs attach to incremental dollars sold? Kendrick, does that answer the question? Business costs. Yeah. These are there's different costs. We'll actually see that in a second, but it can be any cost of the business that's related to the operations is really what it comes down to. It could be a cost related to selling cookies in this case, or it could be like the salaries, or it could be rent. Now, again, depending on the category, you probably make a different judgment call around how you'd project it, but literally any operating cost of the business can be projected this way. So to that point, if that doesn't answer it, awesome. Good to hear it. I'm glad to hear it. Let's actually see this in action. I think it'll actually make more sense, particularly for those who haven't seen this, when we see it in action here. So I'm going to pop open my instructions. And again, to the point Leo was making earlier, when we build out a model, or when we build out this model, sorry, you can pop the instructions open by hitting the little plus or the minus here. So we can see the instructions for how to build the various steps here. So before we get into the actual model build here, I'm going to quickly calculate again depreciation. So the $50 divided by 5 and the bank loan dollars times the interest rate. And then down below, I'm going to start building out my, my income statement. I'll give you all 30 seconds to calculate depreciation. Again, it's cookie stand divided by years and then bank loan times rate. Okay. Now we're going to get into our projections. What we're doing now is financial modeling. So with financial modeling, we're carrying things into the future. The first thing we'll carry here is revenue into the future. So we're going to say we have $100 revenue in the prior year, and up above, we have an assumed growth of 50%. So we're going to multiply, in parentheses, the prior year's revenue by 1 plus our assumed growth rate up above. And that will give us, if I press enter here, the projected revenue. So now I can see that what I'm saying here is basically revenue will grow by 50% or from $100 to $150. Let's give you all a second to punch that in. I take a little time on each of these because I want to make sure we get the mechanics down. Then on the cost, it's a little different. We're going to attach costs to the revenues as opposed to just growing the revenue, growing the cost for the first category of costs here. So as we sell more cookies, right, we're probably going to incur costs proportional to the growth in revenue. If we sell more cookies, we incur more cookie costs. So what we're going to say here is that we're going to multiply, I'm going to take the negative here of my cookie costs and then multiply that by my revenue. And what I'm saying is, as my revenue grows, 35 cents of every dollar sold is going to have cookie costs attached to that. And then for salaries, let's imagine we have one employee that helps us and we need to grow. We need some contract help here because we can't afford a new employee. So we're going to grow the salary based, but it doesn't need to grow directly in line with the growth of the business because we don't need a full new employee. So we're going to hire a contractor, let's say. So for the salary growth, I'm just going to multiply by 1 plus the salary cost growth. And what we're going to assume is our salary expenses or employee expenses grow by, we'll say it's a part-time employee. It's probably better because they're technically employees here. Part-time employee comes on, we're going to pay them, and it's going to grow by 25%. So someone asked a question here while we're waiting. Why was the other one not a percentage of revenue? There isn't a right or wrong here. So you could actually, I could present the cookie cost as a year-over-year growth, or I could present it as percentage of revenue. You can do it either way. These are going to be the two most common that you'll see. They can be either one as a short story. Generally speaking, though, with costs that are the bigger point here is with costs that are going to grow in line with the business. So if we think of, again, running the cookie stand, if I'm growing the business is growing, I'm probably going to sell more cookies. Well, those cookie costs are going to come along. I probably don't need another cookie stand though for a while, as an example. And so, or let's say a cash register or whatever the case may be. And so some costs are not going to grow directly proportionally to the business. So things we think are going to grow directly proportionally to the business, we're probably going to use this percentage of revenue approach. But for things that aren't going to grow quite as fast, we're probably going to use a year-over-year growth approach. So hopefully that answers that question. If it doesn't, let me know. Happy to try again. From there, I'm going to speed things up a little bit here. We're going to pull in depreciation. We're going to pull in the interest. And just like last time, we're going to calculate our taxes as the negative of our taxable income times our tax rate. Give you all a second to catch up on that one. I'm actually gonna, while we're waiting, close this out. I'm gonna pop open the instructions here. All right, from there, we're gonna move over to our balance sheet, similar to what we did last time, just to start off with here. We're gonna pull in the inventory balance and the owed to supplier, which we more formally call accounts payable balance. So we're gonna pull in our inventory and we'll pull in our money owed to the supplier. We're pulling that in from G17 and G18. And then over to the right, we're going to do exactly what we did before by pulling in or calculating, I should say, the bridge or the path from the profit we made down to the cash actually made by the business. So there are two ways to do this, by the way. One way, just as an aside, is to redo the calculations we did before. So we could pull in net profit, we could pull in depreciation and so on and so forth, and then make the changes again, prior minus current, current minus prior. But in financial modeling, you're always looking for ways to speed things up a little bit. This is actually an area where we could speed things up. So what I'm going to do as an alternative is I'm going to highlight the entire range from F25 down to F28. And I did that by pressing Shift and then my down arrow key a few times. I'm going to hit Shift and go over to the right. And I'm going to hit Control or Command on a Mac, R. And what that's going to do is just copy the formulas over to the right. It's like a copy paste, but it just copies to the right. And we've done here, and if you want to do it manually, by the way, just to quickly do it while people are doing that, you can pull in the net profit. You can calculate prior minus current. I'm sorry. You can add back depreciation. Calculate prior minus current, just like we did before. Calculate current minus prior, just like we did before, and you'll end up in the exact same place. So whether you manually do it or just copy it over, you should end up with the same answer, but copying it over is clearly faster. From there, we're going to record the $25 that we spent on the cash register at the very end of this year 2. So I'm going to pull in the $25, but remember, this is the cash flow statement. So what we're saying is, did money go in or out of the system? So we reflect this as a negative because we purchased the cash register. So that's money we had to put out for the cash register. And then before we wrap everything up with cash and tie all the 3 statements together, I'm going to go back over to my balance sheet here. And what I'm going to do is wrap up the equipment, the bank loan, and the owner investment and profit before we tie knot on this. So with the equipment, what we're going to do again is capture the cumulative balance of our cookie stand and now ultimately the cash register. Remember, it's what we purchased less the depreciation incurred. Now, the tendency or the inclination here might be to go, okay, well, I'm going to take the prior period and I'm going to add in the 25 we purchased, which isn't the end of the world, but more properly coming from a model, you really should be pulling it from the cash flow statement because that's where we reflected the cash outflow. So what I would encourage you to do is take the negative of the equipment purchase, where you're just flipping the negative here. And we're basically saying, I went from 40 minus a minus to get to a positive. It's just the way we typically present it in a model. I went from 40 to I purchased 25 more, so my balance went up by 25. And by the way, if you're more comfortable for now, if it's more intuitive to just grab the 25 here to get to the same place, that's not the end of the world. So whichever works best for you. But either way, we need to capture the fact that we purchased the cash register. And then we need to record the depreciation here. So we're going to type plus, and then we're going to incorporate, just go back over here, the depreciation that we incurred in row 28 here. And that'll get us to the ending balance for our equipment, which is now a cookie stand and a cash register. And again, it's what we purchased, less the depreciation. Then down below, we have our bank loan. So with our bank loan, we have, again, a kind of a simple situation. We had a loan at the beginning of 100. We didn't borrow anything new. So we are going to press enter here. It's going to be a prior period plus the cash, and that's kind of it. And then for the owner investment and profit, it's going to be the prior period, where remember, these are cumulative balances, prior period balance, plus what was invested in the period by the owners, 0, plus any incremental profit from running the business, which was 42 in this period. And with that completed, the last thing to incorporate here is our change in cash. So if I actually give you all a second to punch that in, I'm going to open that formula back up, just give us a chance to plug it all in. Okay. So last thing to do here is change in cash. And again, it's the three things. It's how much we made, reinvestment, and the money in and out from lenders and investors. So it's business cash flow, reinvestment, business funding, money in and out from lenders and investors. Gets us to $17. And that's how much cash actually flowed through this business. And now we're going to go up to our bank account, our cash balance, and say, okay, well, where do we end the last year? Let's add to that the change in cash that we generated during the period. And that gets us to 167. And what you should see when you finish that is a balancing balance sheet. I'm going to pause there for a sec. Okay. I want to step back from this for a sec and just talk about what we've created. So this is really, there's a couple of tweaks we're going to make, but this is in essence the financial model. So now we have let me just close this out here. We have the three statements. They're dynamic with a couple of exceptions. The exceptions here are going to be your inventory, your money owed to suppliers, and the purchases. But let's imagine the boss comes back in and says, okay, I get it. We're growing at 50%, but like what happens if the business grows at 60% next year? Well, we can plug that in here now. And I can see all the numbers move. And actually, to the point of the question that was asked earlier, I want to think about, and this is more understanding the business, I want to think about how these costs should tick up with the business. And what we've done here is we said, okay, as it grows, we're going to attach certain costs to the growth of the business, and other ones, they won't grow in line with the business. And so ultimately what we're aiming for here is in an Excel file, a reflection of where this business is headed. And that's underlying a function of what does the business do. Again, we're like 2 steps from a financial model here. I'm going to stop there and see if there are any questions. Because I've had a lot of really good questions, so I'd love to get 1 or 2 more. All righty, let's carry on. Let's make a model. So we have the year 2 numbers, and I'm going to stick in Excel now and just kind of work from year 2 to year 3. And from year 2 to year 3, we're going to actually build really what is more of a proper model. It's a few minor tweaks at this point. So let's let's actually start making some changes to terminology here. I'm going to zoom in. Again, zooming in for the PC folks, Control, Alt, plus, and minus. I'm zooming in a little bit so we can see that. Maybe a little back out, Control, Alt, minus. For Mac folks, you can go to View and then zoom here. And you'll see that we have these labels that I've been using all along. But what I'm going to do is I'm going to tweak them. So I'm going to, this is just a drop down so you can see that there's sort of the more proper name here. I'm going to tweak the label here from change in inventory to changes in current assets, changes in current liabilities. So we've been working with inventory and accounts payable. Inventory is just one of a handful of common current liabilities that you'll learn about in accounting. And accounts payable is just one type of, I'm sorry, take that back. Inventory is just one type of current asset. I misspoke there. And there's accounts receivable, there's prepaid expenses, you could have other current liabilities. There are other things that can fit into that bucket. And then on the liability side, similarly, there's accrued liabilities, there's deferred revenue. There are other items that can fit into that bucket. So more broadly, what we're capturing here is not just inventory and the money owed to suppliers, but rather all of the items that are like inventory or in that same vein of really on the top side of the balance sheet, tied up cash, and then really money that's lent to us across a few different categories of items that you'll learn in accounting. So these are the more formal sort of names for these. And then the other, there's two more adjustments here. Oh, someone just asked a question. Hold on one second. Let me see if I can answer the question. There it is. So I'm going to say keyboard shortcut for opening the drop downs. It should be Alt and then the down arrow key. So then for increase in debt, as you can probably imagine, debt doesn't go one direction. It can be paid down too. So we're going to tweak this. It should be, I was keeping it simple here, but it should be increases or decreases in debt. So we can borrow or we can repay. And then we mentioned dividends briefly. We just didn't have a line for it. So I'm going to add in a line for dividends. Okay. And just more like conventions of presenting things. And you'll notice, by the way, that across the board, I should have mentioned this, that I've changed these now to the more formal names. Now you can pop this open now in reverse reference, if you will, the less formal names, if you'd like. But now we're showing more, again, we're trying to get closer to a real model. We're going to use the formal names that you traditionally see in a model. Now, one of the easier exercises of the night is creating the next year of the income statement. If you look up above, let me just ask a question here. So someone said, in real life, do you create a template for what you're doing, or do you create by scratch? It's actually a fair question. Depending on the firm you work at, a lot of firms like templates. Some firms like creating from scratch. There are different views on this. I actually worked at a bank when I first started, where everything was built from scratch. Maybe not the most efficient thing in the world, but from a learning perspective, if you can go to a place that does everything from scratch, I think it's a better way to learn. It's easier to see what's happening. It's a little more annoying to start with, but I would strongly recommend it. So if you look up above though, and hopefully that answers the question, please keep asking questions, guys. So awesome questions. I want to answer all your questions if you have them. Please ask. You look up above here, you're going to see I have year 3 assumptions for the next year. We've already set up our model. We already have, I'm actually going to quick shortcut here. If you want to group rows and columns, Shift Alt, and then the right arrow key. I'm just going to group these for a second so we can see the top. We already have projected revenue growth for the prior year, cost as a percentage of revenue. All these different things are more or less set up. We don't need to redo that. So what we can do is we can highlight the entire range from G34 down to G42. To do that quickly, I'm going to press Control and then Shift or Command Shift for Mac, down arrow. And then I'm going to hold Shift and then go right arrow. You can probably guess where I'm going with this. The instructions are here on the right. Control R, or if it's easier for you, Control C, Control V, because the formulas are exactly the same. So now what we're going to do is we're just going to use a different set of assumptions to project the next year. Okay. And then, so I'll give you all a chance to do that. But again, it's just literally Control C for copy, Control V, or the more sort of proper way to do it if you're learning how to move faster in Excel is just highlight the whole thing, Control R. Now we have our projections. We really don't have to do a whole lot there. It's the nice thing about models. Once you set them up the first time, they can be rewired. And I'm going to close this out. The real tweak we're going to make from a mechanical perspective is, if we think about the inventory we had in here and the accounts payable that we had in here, They were hard-coded numbers, meaning we just jammed a number in. But really, if I have a business that's growing faster, I'm going to have more inventory. If I have a business that's growing slower, I'm going to have less inventory. So we want to make those kinds of things more dynamic. They shouldn't just be like a hard-coded number that's fixed. So to that point, I've included some assumptions here to allow us to do that, where I'm going to, for example, I'm going to take, and the instructions are here, I'm going to take the inventory percentage of sales for year 3, and I'm going to multiply that by revenue. And what I'm saying here implicitly is, as the business grows, some percentage of that growth is going to be captured by inventory. Or said differently, the inventory will go proportional to the growth in revenue. Press enter. And then on the other side of things, same deal with accounts payable. I'm going to assume that, remember, accounts payable in this particular example are half of inventory. So I'm going to assume that accounts payable are 25% of revenue, or half of what the inventory will be. And that's kind of the big twist for this. There's one other item that's like that. The big twist for this next version is basically just saying, okay, we want to keep everything kind of proportional to the business's growth. So we're really capturing that underlying business. Lastly, with owner's equity, I actually said this earlier, but we need to make a quick update to our owner's equity, which we call owner's equity retained earnings, combined here in one line to this model's formula. And what we're going to do simply here is just take the prior period. So just a quick refresher as to what we're doing, by the way. So it's prior period plus money invested by the owners, plus any profit. And even though they're zero, just as a best practice, we want to make sure we're capturing everything here, even in historical periods. I'm going to add to this the dividends that could have been paid. They weren't paid, but we want to keep everything kind of consistent. So I'm going to press enter here. And what I'm doing is just saying, okay, if there's a dividend that's paid, we're going to reflect that. And once that's completed, I'm going to copy it to the right. So shift over to the right, or control C, control V does the same thing. Control R is how I'll do it, but you could just do, again, control C, control V. Either one works. Command C, Command V, by the way, for Mac. From there, similar to the income statement, we've already set up our formulas. Our cash is just going to change based on the change in cash, right? We've set up the formula for this. This is dynamic. Our property, plant, and equipment is going to be what we purchased in the year, less any depreciation. That formula is already good to go. We sum it up. This one's dynamic now based on what we just changed in year 3. The debt is going to be a function, just to, again, recapping here, of the prior period plus any borrowings or repayments. And then owner's equity is going to be the prior period plus any investments by the owners, any payments to the owners, and then any accumulated profit. So the formulas are already there. We just simply need to move them over. And you could, again, use that control R or command R, or just do control C, control V, control C, control V. Don't copy over these two. They need to stay in place. These are good. Don't copy over the 2 dark blue ones at the top. But control C, control V. Actually, we do the whole thing here. Control C, control V. Okay. You all second to catch up there? All right, we're almost there. So then going over to the cash flow statement, actually a very similar exercise here. So what we need to do is now make our capital expenditures, our I should terminology here, I'm careful here, our equipment purchases, which we more formally call capital expenditures. So when we're buying like the cookie stand, the cash register, a building, that sort of thing, we want to make that proportional to the business in some form or another. So what we're going to do is we're going to take the negative of the capital expenditure percentage of sales, and we'll multiply that by our revenue. Press enter. You all second to do that. And what we're saying here is basically as we grow, we're probably going to have to buy more equipment. So we want to keep that proportional. We'll also imagine that we repaid $10 in debt. So we're going to grab the $10 in cell H27. Let's make it negative though, because we're paying money. It's a cash outflow. This is the cash flow statement. And then finally, the owners are making some money now, so they're going to pay themselves. So we'll assume that the owners pay themselves 10% of the profit they generate in a given period. Give you all a second again to kind of work through those. And with that completed, we can now carry everything over just like we did with the other three statements. Because again, the formulas are mechanically the same from year to year. So again, I'm going to go Control C, Control V. This one's good to go. So Control C, Control V, Control C, Control V, Control C, Control V. And when I finish that last copy paste, you'll notice the balance check is in gear. And now we have really a miniature three-statement model. So again, I'll stop there. I have a few more thoughts here, but this is really a model in a nutshell. I said 2 hours. We're at 1 hour and 42 minutes. So we're getting pretty close. Change in debt. Yep, absolutely. Someone's asking change in debt. I should really make that a black font as well. Change in debt is just literally, we assume there was a debt repayment. We're just linking to it and it's a negative. There's a few comments I want to make about this, but that one's just a link. Okay. So from here, the next step is really building up a proper model. And there are a few little notes that I'd like to make just to kind of clarify this. If you go from here, if you continue on this journey and you go from here to a proper model, the other thing that you'll see is sort of incremental complexity, or there's really two, I guess, is that with some of the balance sheet accounts, you're going to see the components laid out on what's called a schedule. So we'll actually have a little section that basically says, okay, well, the starting balance is 55. Let's now lay out the purchases as a line item, and then the depreciation as a line item, and then the ending balance, and that just links back to the balance sheet. So for certain accounts, you might see a more broken out section, which is called a schedule. It's the same thing. We're just doing it in a single formula here. And then in particular for debt, someone actually just asked a question about debt. The debt actually breaks, in particular, as you get into leveraged buyout models where you're doing much more complex debt, the debt breaks into what's called a debt schedule or a debt table, where you do much more complex calculations around who gets paid and when. And that's kind of almost its own exercise. But those are the additional layers of complexity. Aside from that, again, if you can get the big picture of this, I think a lot of all the other pieces will fall into place because this is a financial model in a nutshell. I'm going to stop there, folks. There are a few more points I want to make, but I'm happy. Oh, someone said debt and dividends. Just make sure I'm answering that. So real quick, just on dividends, what we're saying here, just to kind of explain this in plain English, if I'm running a business, let's say I make $80, I might say, okay, well, I'm going to pay myself as the owner, or maybe the shareholders vote for this. But one way or the other, the owner or the shareholders vote to pay some percentage of that out to themselves. The percentage, by the way, is referred to as a payout ratio. So what percentage of my profit am I paying out? And what we're saying here is what percentage is paid out in cash to the owners of the business. The other small note to make here is it's a little different than debt. With debt, we borrow and repay. With equity, we don't repay equity. What we do is we bring in equity to the business, but then we pay the owners because the owners don't get repaid. They own the business. So unless we buy back their stock, which is a different thing. Sort of a side conversation. All right. So someone's asking about the YouTube channel. It's just it should come up under either financeable or financeable. Thank you. We have financeable training. There's a bunch of actually a few comments to make about that as well. Let me actually jump back over to the slide deck real quick. So even though this course was not an interview prep course, the one thing to note is that in interviews, sometimes you will come across questions related to what we just discussed. You won't in an investment banking interview in particular. You're not going to be asked to build a model, and I've never heard of that. But with that said, they might say, how do you project out revenue? Well, with revenue, I would basically give them the 3 points but beyond the mechanics, start with the mechanics, right? But I would give them the points that I gave you, or just articulate the points in that same form, which is basically, how fast is the market growing? What's the share? And what's kind of the position of the market itself? And where is it in its evolution? Those are kind of your three factors. And then mechanically, it's just year-over-year growth or price times volume. That should get you through. On a cost on the cost side, conceptually, again, what you're trying to do is capture whether or not the cost attached to the growth of the business, or whether or not they're going to be more like steady state, but growing with inflation. And then beyond that, what you're doing mechanically again is either, again, whether if it's growing with the business, it's the percentage of sales. If it's year-over-year growth, or sorry, if it's growing with inflation, it's just year-over-year growth. And then the last one is, how are the three statements connected? And I didn't completely answer that in this particular section. It was more on the modeling. But hopefully you saw as we go through kind of like how these three statements are connected in a little bit of a sense. But the reason I bring this up is there's a whole set of questions around how do things flow through the three statements. on the YouTube channel, actually, the point that was asked, the first, call it 5 videos that I put together in March, actually walk through a framework for answering those questions. And then it's like 3 or 4 different examples of like the common things you're likely to see related to this question. So this is the starting point. But beyond that, I would, beyond that, I would definitely, go to those videos and look at how the flows go. There's like a system to it. There's a method to the madness. If you learn the method, it makes it a lot easier. It's the same comment as the modeling. If you learn the frame of the house, everything else is easier. If you dive into the weeds at the start, it's just a lot more complicated. Beyond that, a few other little comments to me. Oh, actually, I forget. There's actually one more thing on the next slide, but one more thing. On our YouTube channel and on the site, there are 2 articles / videos that I'd strongly recommend anyone going to IB or PE would check out. There is Walk Me Through a DCF and Walk Me Through an LBO. They're 2 of our most popular articles, and they're effectively just I would start with the videos because it's easier to process probably off the bat, and then go through the articles. They're a little more lengthy, but it literally tells you how to answer the questions as opposed to giving you a bunch of facts and saying like, here's what this should look like, but not really explaining like how you actually answer the question. So I'd check that out. I'm trying to get out one on paper LBOs in the next few days, so hang tight for that. I'm really excited about it. It's like every trick I've ever learned about paper LBOs in an article. We'll see how it goes. And then, beyond that, we are teaching, I just put up on the site today, a few of these. There's going to be a few more coming tomorrow. We have a lot of courses on the site that are self-study. And then I'm teaching live courses as well that in January that, you all are welcome to attend. So just to kind of lay out kind of what's there, because there's a lot of pieces and we're still putting the kind of the platform. There's a lot coming over the next year, I guess is the gist of it. So I want to clarify, particularly for those of you that are either looking for interview stuff or aiming to, use this stuff on the job. On the interview side of things, if you're looking at our materials, for interview prep, what I would strongly recommend for anyone who's doing any type of interview prep for banking or PE, but particularly banking, always start, whether it's my materials or otherwise, always start with accounting evaluation. That's the bulk of questions. And so you want to have that foundation. I obviously am biased. I really like our materials, but we really focus in on the concepts. And if you, again, it's the frame of the house thing. Like if you understand the frame, everything else falls into place. And we emphasize the interview prep throughout those courses. Beyond that, I'm going to put out an M&A course shortly. Again, it's more focused on interview prep than like building a merger model. So you understand how to answer those questions. Unfortunately, I don't have an LBO course ready for interview prep, but it's really just the first 2 sections of the LBO modeling course. That's going to be the interview prep version of this. That'll come out in early January. Beyond that, so I've had the privilege of teaching, I won't say the names of the firms, but mega cap PE funds, top tier banks across the board, thousands of students. And the one question I always get, it's actually, we got a variant of it tonight, is like, okay, this is all great, but like, how do I analyze a business? Because I still don't understand what you're saying. And that's actually our business mechanics course. I have not recorded this yet, but I'm teaching it live in January. Stay tuned for that. This is like my favorite course ever. It's where we actually get to talk about businesses and like think about how they move and what they do. I would argue it's kind of like the missing piece in so many pieces of training. So if you want to learn how to analyze business, how to think about it in a more simplistic sort of framework way, definitely check that out. And then for the folks headed to the job, heading to the job, it's basically, let me just go here real quick. And again, there's a lot more coming, but basically the Excel survival kit basically walks you through a real project like you would actually see on the job in banking and private equity. To my knowledge, there's no other course that does that. It's always just a bunch of assorted functions. And then 3-statement modeling, as you would guess, probably LBO modeling, and then modeling mastery. I'm coming up with a bunch of things that, again, try to tackle the more complicated things, particularly with LBO and 3-statement models that just are very hard to like work through if you don't have the proper framing. So all that is what I would focus on. Lots coming here, folks, over the next investment banking simulation. Sorry, too many things, but lots of stuff there, lots of stuff coming. But the punchline here, more so for the folks for interviews, is I'd really focus in on accounting evaluation and to a lesser degree M&A and LBO. The accounting evaluation, I sound like a broken record here probably, but that's where the root of everything is for interview prep for banking in particular. I would, again, my courses are otherwise, but that's where I really zero in. I think I'm going to put on this presentation. I think a lot of folks are giving the advice of like, go build a model. And it's like, if you don't have the foundations, it ends up being a really tough thing to do. It's not that modeling is bad, but like modeling should be the second step or the third step after you really pin down accounting and valuation. Someone's asking here, how do I stay updated on the next seminar? So I guess a few things to note there. Again, bear with me one sec. Thank you so much, guys. I love these things. So if you guys love them, I'm going to keep showing up anyways. Kieran and Leo have had the sad privilege of seeing me just get really excited about finance. If you guys want to do it too, I would love to do more of these. But with that said, let me just show you real quick. I'll just drop it into the chat. So these are the live class. This is where all the classes sit in the chat. Some of them are paid, some of them are not. The more like intro things are going to be unpaid. I'm trying to help people learn about this world. That's like half the mission of this company. And so I would check that out. I would check out those. I'll answer this question in a second. I would check those out. And I'm obviously biased again, but like the prices for the live events are like a fraction of what you're going to find anywhere else. I would love to see you all at those. But I would definitely check out the paid events. I think you're going to see there. I'm trying to kick things off, and I really actually enjoy this stuff. So would love to see you all at the live events as well. Beyond that, let me just see here for a sec. So someone said, I'm looking at the past events on LinkedIn. Can I still access those recordings? So I'm still there. These platforms are tough and they're kind of frustrating technologically to use. And I'm actually pretty good with tech, but like it's always some hiccup. So the short story here is the last one I did. There's really only one that I've done for this type of thing, is on the YouTube channel. It should be under live events, and it's how to value a business. This one, oh, wait a minute. What am I saying? There's two. Okay. I take back what I said. The valuation one's on the YouTube channel. I did not record the Excel one. I'm going to do these again, by the way. But I did not record the Excel one. I'm going to try to get this one on the YouTube channel tonight or tomorrow morning. But I'm going to try going forward. What I would love to be able to do, which I'm supposed to do, but again, technological difficulties, is just live stream these things each time I teach them. But it turns out that's a little more complicated than you might imagine. So that's what's up there now, is basically valuation, and this one coming soon. But I'm going to stop recording here now. But